We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisade's Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Lawrence Lepard from EMA2 Equity Management Associates. Thanks for joining me again, Larry. How are you?
Hey, thanks, Tom. Good to be with you. Merry Christmas, Happy New Year. Better years ahead, hopefully.
Absolutely. We were just discussing how, looking back over 2022, it almost seems like there was nothing good that came out of this year, right?
No, not much. Well, maybe the FTX failure was good. We get to see this criminal hopefully go to jail. We'll see how much political power he has. But yeah, in general, it's been a pretty rough year for the sound money camp, but that'll change. And you got to have rough years before you have great years. So,
Yeah, I think, again, as we were discussing, it almost seems, mathematically, this stuff really does seem to need to work out in the end. And I think just being patient and understanding where these things are headed is a big part of that, right?
Yeah, I completely agree. I mean, it is a mathematical certainty that the government will continue to debase. And I've always looked at investing as kind of a 2 to 5 year window for the things I invest in. And so, you could be wrong for a year or two on a counter trend move like we've had right now, which has been annoying to say the least. But, it presents buying opportunities if you have any capital to buy with. And, I'm quite sure that the thesis isn't broken, that, our stuff is going to do extraordinarily well when we see the Fed, finally pivot.
Mm-hmm. So, Larry, let's look back at 2022. What are some of the lessons that come to mind for you this year? I know you said you didn't have Powell playing Volcker on your bingo card, right?
Right. Yeah, certainly. I knew that, look, the Fed was forced into a position where inflation was raging and they had a crazy speculative market going and they had to hit the brakes. We knew that. What I didn't know is that they would totally slam on the brakes. And I didn't know that they would be as aggressive as they've been. I mean, recall that only a year and a half ago, he said something along the lines of, we're not even thinking about raising rates, right? Which was really an irresponsible thing to say, because at the time, the housing market was on fire and the inflation numbers were just starting to get on fire. And there was a lot of evidence that all the printing and stimulus from COVID was going to create a serious inflation problem. And yet they called it transitory. So, that certainly wasn't on my bingo card to have it be as bad as it's been with the Fed tightening, and not just tightening, but the jawboning and how long it's going to take and all the forward guidance that, and they're playing tough guy. And frankly, that forward guidance to me is very much like the transitory bluff, because they're trying to talk inflation down, and they're trying to talk the bond market into being comfortable that they are going to do whatever it takes to whip inflation. And to be frank, and the deviant perception out there right now, I believe, is that a lot of people, a lot of investors are thinking, okay, this is going to work. The Fed will get things under control and inflation will come down. If you look at the 5x5 inflation swaps, they're in the 2.8 range. And if you look at the bond market, it's hung in there. The long bond hasn't gone up to where as high as it was earlier. And, I think people think we're going to return to the world that existed before COVID, where inflation is tame and growth is steady and everything is kind of good. And I don't believe that's the case. I think that's a fantasy and that's very unlikely to occur. And there are a lot of things that point to why, I think my argument is right. One of the biggest is that labor costs are going up 5 or 6% a year. And the inflation was so big and so extreme that, that labor has got power. And we're at, the Fed's got 3 mandates, right? Full employment, low inflation, and the unwritten mandate is financial stability. And they're winning on the low employment. I mean, we're at full employment. Employers say they can't find people to work for them, et cetera. Wages are being pushed up, so forth. They're losing terribly on inflation, and they're trying to solve that with this rate hike. And then the financial stability, well, so far so good, but the rivets are starting to pop out slowly but surely, and and maybe eventually one of the panels is going to come off. So it's kind of a mixed message that they're sending to us right now. Well, the message they're sending to us is no, we're going to get inflation down. I should say people's interpretation of it, I think, is mixed. There are a lot of people who've been strongly conditioned to buy the dip from 2009, and the bond market is somewhat euthanized, in my opinion, because inflation really is 5, 6, 7, 8%. The long bond shouldn't be in the 3s and 4s. Mm-hmm. It should be above the 5, 6, 7%. But I think what the bond market's saying and what people are believing and the swaps indicate is that everyone think, well, this inflation will come down, and it started to come down. I mean, it's not 8 or 9; it's kind of 7-ish, and I'm sure the next few prints will be better. So, I point people towards Tavi Costa's chart on Twitter, which is so great, of the inflation in the 70s, and it kind of comes in waves, right? I mean, it runs up and gets pretty hot, and then they do something. They did this in the 70s too. They tighten and they jawbone. They say we're going to get under control, and so it comes back down a bit, but then not all the way down to where it started, right? Just back down somewhat, and then it gets going again. And so I think that's kind of the environment that we're in. We are in. We saw peak deflation in March of 2020, when oil traded at a negative price. That was the peak, and there were, $20 billion or $1 trillion of negative yielding bonds in the world. That was peak deflation. Now, in my opinion, and it was 40 years, right? That took us to get there, from 1980 to 42 years to 2022, or 2020, I should say. And now we're in an inflationary world. And the question is it going to be mildly inflationary or highly inflationary? Interesting to me that in the last go around the Fed, there's been some talk outside of the Fed speakers, but people who are close to the Fed saying maybe it's time to start reconsidering whether 2% is the right inflation number, mm-hmm. right? And so there's another clue. They're going to probably just have to learn to live with higher inflation, and we are going to live with inflation for a number of years now, in my opinion.
Larry, it seems like everything is almost always about the Fed, and how it really it affects the rest of the world. So why do you think that the pivot is basically mathematically assured, and what do you think ends up being the straw that breaks that camel's back?
Great questions, and this goes to what we were talking about earlier in the term I used, kind of the doom loop, right? The debt doom loop. I mean, mm-hmm. So start with the interest on the debt. I mean, the U.S. has 31 trillion of debt, soon to be 32, 3 or 4, right? And the cost of that right now, the run rate cost of that right now is about $750 billion a year. As recently as a couple of years ago, that was in the $300 billion range. So that's more than doubled in a few years. And before that, it was in the $200 billion range. So these higher interest rates have created a much higher cost of carrying the debt. And that's important because it goes through the federal government budget and and creates a deficit. And we're kind of running, all things being equal, we run a $1 trillion deficit just the day we start the year before we do anything. Mm-hmm. And that's assuming that the economy is healthy. I mean, this year the deficit was about 1.4, and that's true if the student debt forgiveness holds up. And that was really inflated, or that was better than it should have been, because the year that we just had that ended, the September fiscal year, had the income from the bull market of 2021 in the stock market. So in other words, as everyone knows, the stock market hit a record high in December of 2021, mm-hmm. one of the best years ever, big throw over on the upside. And so as a result of that, $600 billion roughly of capital gains taxes got paid that will not repeat this coming year. And the reason for that is the stock market's down this year. So people aren't going to have big capital gains to pay the government. And so you've got an increase of $600 billion there. You've got an increase of a couple $100 billion from the higher interest rates. Your Social Security in the U.S. and Medicare just adjusted up 8.7%. So that adds another $120 billion, all right? And then you've got, the money we're giving to Ukraine and student debt forgiveness, and there'll probably be more of that, et cetera, et cetera. And you can easily pencil out to where the coming year deficit for the fiscal year ended September 2022 is going to be somewhere in the $2 to $2.5 billion range. And Luke Groman is in a very excellent piece of analysis, pointed out how, the Treasury even tells you this, because they have their projected borrowings for the first 6 months of this fiscal year, and they're projecting $1.3 trillion of borrowings that they need to bring in. So that implies we're running at a $2.6 trillion deficit. And and this is really important. I mean, to connect back to your question, why things are going to break. So, if we run a $2.6 trillion deficit, somebody's got to buy those bonds, and you've got bonds rolling over. And, they're crowding out. There's only so much capacity in the world to buy those bonds in private hands and other hands. And right now we've seen it more recently that, England, Japan, and China have all been sellers of those bonds. And so, without buyers of the bonds, they have to go to a higher interest rate in order to get sold. And the 10 years have been having, bad auctions and short tails and all that kind of stuff. So as a result of that, the fiscal picture just gets kind of worse and worse, and the debt gets larger and larger. And think about it, every piece of debt adds to that interest expense, and to the degree that interest rates go up, that $750 trillion or $1 billion of interest a year becomes $1 billion, $1.2 billion, $1.3 billion. I mean, pick the number for whatever the interest rate is, multiply it times the 32 trillion of debt that we'll soon have. I mean, you get to if it's 6 as an example, you get to a pretty damn big number. I mean, that could be, 1.8, trillion dollars of interest expense. This is something that a few years ago was 300. Now, don't get me wrong, all the debt doesn't roll over instantly. They have some long debt, et cetera, but the average maturity on the debt is kind of in the 3-year category. So in a few years, the problem continues to get worse. If the government keeps running these budget deficits, the debt number gets bigger. And so eventually, less buyers of the debt, higher interest rates. And to me, the debt market is going to be the tell, and the stock market as well, because two other things I haven't talked about are factored in here is, one, if we do enter a recession, and the spread between the 2 and the 10 would indicate every time it's been this blown out, we've had a recession, right? So if we do indicate, we do enter a recession, we can be quite certain that tax revenues will be going down. In the 08 example, or in the 2000 example, 2002 example, tax revenues were down kind of 8 to 15%. And then in turn, in those kind of downturns, unemployment and other social spending kicks in, so expenses go up. So, I think you can see where I'm going here. I mean, even before factoring that in, we're penciling in a $2.5 trillion deficit. Start adding that in, you're kind of going to be at a $3.5 trillion. You're going to be at a big deficit number. Again, more debt that's got to be sold. So, the Fed is sitting there and they're pretending, they're bluffing, very much the way they said it's transitory. Now they're saying, we got it all under control. We can drain this. We can sell these bonds. We can push these rates up, and the economy is going to be able to handle it. And I think they're making a mistake. I don't think the economy will be able to handle it. I mean, I think if they continue to push this line of thinking for a long time, we're going to have a downturn that's going to, rival the Great Depression. So that's a very bad thing, obviously. And I don't think they will. I don't think they'll go that far, because I think they're smart enough to know that if they kill the economy completely to solve inflation, well, then we got no economy. So I think that, they will, just as quickly as they went from, inflation's transitory, we don't have a problem, to, oh my God, we got a serious inflation problem and I'm Paul Volcker and I'm going to solve it. They're going to go back to, oh, look, see, inflation's come down a lot. Maybe it's 5%, right? And it's trending lower, so we think it's going to go lower. And oh boy, the economy is not doing so well. And you're right, we really do need to lighten up here. And probably to me, the big crack in their facade is when they have to go to yield curve control. I mean, what they cannot have happen, they can't have the 10-year market fail. They can't have the government bond market fail. If they don't have enough buyers for those bonds, then they're going to, at an interest rate that they can service, then they are going to have to become buyers of those bonds. They're going to have to become Japan. And as you and I discussed, Japan just, they just capitulated. They had a 10-year yield curve control program locked in at 25 basis points. They just had to go to 50 because the market ran them over. And that's what's going to happen to all of these things. I mean, these arrogant government officials think they're bigger than markets. And in the short term, because people believe them and because they can jawbone and because they have the bully pulpit, they can be right. But in the long term, the math is unrelenting, right? I mean, the debt interest has to be paid. Somebody has to buy the bonds at a negative yield. I mean, even today, this shows you that people think yields are coming back down. Who would buy a long bond with a 4% yield with inflation running at 7 or 8%? Doesn't make any sense. Obviously, people are buying those long bonds. They think inflation's coming down. but I don't think inflation's coming down. And so again, it's kind of a doom loop that as it gets worse and worse, they're going to be there. We said they're trapped, and they're going to be forced into, do we continue to try to tame inflation and push interest rates at 10%, at which point half the country is bankrupt. The stock market's down 50%, and the negative wealth effect is enormous. All possible. I mean, it's not out of the realm of possibility. Or do they say, do they try and thread the needle and find the time between where they determine, okay, inflation is the greater threat and collapse is the greater threat. All right, time to lighten up on the inflation concerns and address the collapse concerns. Mm-hmm. The way they address the collapse concerns is yield curve control, reversing of QE, cutting interest rates, all the above, right? Mm-hmm. All the things they did in the GFC, all the things they did after the dot-com bubble burst. And of course, what they can't see is that they blow the bubbles and then they burst and then they kind of come to the rescue. As to the timing, which you asked in your question, I think it happens early to mid next year. And my logic is kind of twofold. I'm looking at what happened in the 07 and 08 timeframe. The Bear Stearns funds blew up in the summer of 07. And the whole thing, hit the wall in October of 08. So July to October. So call it a year and a year and 4 or 5 months, something like that. If you kind of consider this bubble kind of ended at the peak stock market of December of 2021. So we're now 1 year into it, right? Mm-hmm. All right, add another 5 months. Or the tightening cycle started in February, March of 2022. So add a year and a half to that. And you've got rivets popping out. I mean, the Italian bond blowout was a rivet that blew out. Britain, we talked about this earlier. The Britain thing was a rivet this summer. I mean, suddenly the government there says, well, we're going to cut taxes and we're going to spend more. And the bond and the foreign currency markets have said, no, you're not. Or, yeah, you can do that. But guess what? The pound is about to collapse and, the gilt yield is about to go straight up. And of course, that brought on a lot of interesting things because suddenly the gilt yield going straight up meant that all their pension funds were going to blow out because they'd all done the risk parity trade with the LDI, the liquidity-driven investment stuff to try and enhance their yields. And so it goes to Buffett's thing. I mean, the tide starts going out, you see who's not swimming or who's swimming naked. And so, there's so much leverage in the system, Tom. They're trying to hold it all together, and they've done an admirable job of holding it together. But my opinion is that it's just a matter of time before a few more rivets blow out, and they're forced into, what I call their third mandate, which is financial stability. Mm-hmm. And recall that, in March of 2020, when the COVID thing happened and the markets started going south incredibly quickly, as a result of the virus, they came in with, Mario Draghi, everything it'll take, all bazookas, all kinds of new programs, new debt, new this, new that. And so, if you see a GSIB, a globally significant, international bank fail, like a Credit Suisse, or you see a derivative blow up, or you see another case like England, and I don't know where it starts, but something big is going to break, and they're going to be, and then there's going to be contagion, very much like in 08, and then they're going to have to realize that it's much more important to keep the system together than it is to worry about inflation. And so that will just be, that'll send our stuff into orbit, right? Mm-hmm. I mean, gold will take out 2,000, silver will take out $30, Bitcoin will be much higher. All non-state money will benefit as against the state money, which obviously is going to need to be printed in a large way. I mean, as we all know, the last cycle, we printed in, 6 months what it had taken years in QE 1 and 2 and, the GFC to print. And, the Fed balance sheet's now 9, just under 9, coming down slightly, up from before that it was in the 4, then high 3s. I think the Fed balance sheet's going north of 20, maybe 25 on the next cycle, right? I mean, that's the way this thing works. I mean, if you've got a credit-based economy, you have to continue creating credit. It's Richard Russell. It's inflate or die. If they do not continue to inflate the system with more money, then the system will die. Which is why, our stuff is such a comfortable investment if your time frame and if you have the patience and you're not levered and you can withstand the volatility and the swings, because God knows these guys are so both a combination of evil and stupid that they've created some really big swings here. I mean, we've talked about this, the price of lumber. I mean, how do you operate, if you're a builder, where, a year and a half ago around here, they were having bidding wars on houses. And now a house comes up for a listing, it doesn't move.
Well, that's something I wanted to ask you about, Larry. Existing home sales are down basically to the 2020 lows. So is this one of those leading indicators of an actual recession as it affects Main Street?
I really think it is, Tom. I mean, I think that, car sales, the same thing. I mean, I think that, we're just, I mean, through each of these cycles, certain housing goes first, cars go second and jobs go third, and arguably maybe even some of the commodities go. I mean, it's in my mind as a question mark. I tweeted something on copper this morning. I think the chart looks constructive, but I mean, to me right now, the interesting question is how far will they go in overdoing it? And will they overdo it so much that they actually start the contagion and they can't reverse it? In other words, in Powell's desire to be Volcker-like, will he knowingly go almost too far and really get things wrong? Because if and ironically, the longer he goes that way, the more he's going to have to print on the other side to bail it out when it finally breaks, because it will break. Things will break. I tend to think, though, that they're not. Sometimes I think they're stupid. Other times I don't. I go back and forth on that. But I tend to think that they will, and you see this too. And if you read the minutes carefully and you hear all the people who talk to them, et cetera, there are two divisions within the Fed. I mean, the Lyle Brainerd camp, and you've seen some dissent. I mean, the Lyle Brainerd camp is very much of a, hey, we've gone too far and this is going to crater the economy. And the Powell camp, I mean, Powell has made it be known, according to people who've talked to him and interviewed him in DC, and it's kind of come in third hand, but I think it's probably accurate that he said, I'm not going to be the guy that blew 40 years of price stability. I'm just not going to be that guy. I don't give a shit what it takes. So that implies to me that there's actually a greater than average risk that he actually will drive the economy into the ground. Which would be bad for us, because it might mean it might take another year for that to happen. We might have to wait for another year. We might have another year of kind of shitty results. Having said that, as I look at the gold and silver charts, and I kind of look at how everything is trending and behaving, the market's saying that's not what's happening. The market's saying the market smells a pivot. The market and the pivot, by the way, there are lots of degrees of pivot, right? I mean, one degree of pivot is just, well, I'm going to stop raising rates. We've reached, I mean, the peak. Maybe he does one more 75 bips or whatever. He gets to 4.5%, 5%. I'm done. That's part of the pivot. Then the next pivot is, well, okay, I'm going to leave him here and maybe even consider lowering him. I mean, he can jawbone a pivot, right? Then another part is, well, this QT that we're doing, we're going to put that on hold for a while. We're not going to shrink the balance sheet anymore. We're going to leave it right where it is. And then of course everything breaks. Oh my God, the world is coming to an end. That's we're going to drop rates and we're going to go back to QE. I mean, that's the incredible, and that's the floodgates. I mean, that's when our stuff goes bananas, because what's important here, and we've had this conversation many times, what's important here is the psychology of, you and I know it, and people in the hard money community know it. We know they can never stop printing. We know that. But what percentage are we of the population? I don't know. We're certainly not a majority, right? Whether we're 1% or 10%. I mean, I think, who knows? In Canada, it's probably higher because you guys are resource based. But, call it 10% of the population, 10, 15% really has an idea what's going on here. But when they have to go back to, when they're forced into going back to printing because of the conditions that have forced them to do it, there's a larger piece, with every swing, there's a larger piece of the population that goes, these guys can never stop. They just can't stop this shit. They're going to keep printing forever. And gosh, what that means is that these bonds and stocks that I own, particularly the bonds, they're just not going to hold their value. And God, the stock market's down this year. That sucks. The bond market's down this year. That sucks. God, that gold shit, it's flat this year. Maybe next year, God, that gold's up pretty good. And those gold stocks are up a ton. That's really working. gosh, maybe I need to take some of the capital, some of the accumulated capital I have that's over in these bonds and stocks and go over there. And
some of the capital I have left.
So yeah, actually, as they try to hammer my 401k plan, and again, we've also had this discussion. There's 450 trillion of fiat in the world, right? Of stocks, bonds, cash, all that shit. What is it? All the gold that's tradable is 5 trillion, and all the gold stocks in the world are like another trillion, and Bitcoin's like 400 billion. So like $5 or $6 trillion worth of sound money stuff. I mean, oil should be counted in there, real estate too, but for the sake of money, real estate's not very transportable, and oil gets burnt up. So it's 450 trillion of fiat stuff and 6 billion of sound money stuff. We don't need all 450 to say I need to buy gold. We just need at the margin for investors and capital allocators to go, maybe this inflation is pretty embedded, and maybe this is going to look more like the 70s. I better have some more of my capital and things that protect me against that, right? Mm-hmm. And that alone will take us to much, much higher levels. There's a lot of leverage in what we have there. So that's kind of how I see it.
Larry, does the sentiment inform us as to the position, or let's say attractiveness, of gold and silver miners at this point too?
Yeah, I think it does. I mean, I think there was a great tweet recently. Somebody put it up there on kind of, I think it might have been Fred Hickey. I can't recall who it was, but somebody had a tweet about Wall Street's projections for gold, for the next 5 years. They kind of had it as flat. Mm-hmm. And Rick Rule weighed in on it and said, this is really good. Oh, it was Ronnie Stoufferle who put it up. Said, this is really good stuff, guys. I mean, this is what we want to see. Yeah, and the gold miners are bombed out. Everybody hates them. Sentiment's horrible. I mean, there's no mania going on in gold miners. Mm-hmm. There's no, remember, and this reminds me of the 80s, the early 80s. People invest in the rearview mirror. The average investor has done extremely well buying the dip on regular stocks. And gold and silver have been forgotten, and inflation hedges have been forgotten, because inflation hasn't been a problem since the 1970s. That's 40 years of conditioning. And, I'm not saying gold and silver are always good investments. I mean, when you've got a healthy economy and a healthy credit structure and things are growing and leverage isn't too large, you've got room to grow, they're not particularly attractive. I mean, in the 80s, gold did terribly. In the 90s, it did a little less terribly. And since then, we've kind of entered a bull market. But, during periods where you're going through a reset, which I think we are, and during periods where you've got too much debt and you've got a credit problem, both of which I believe are true, these can lead to money printing and inflation, and gold does extraordinarily well. And so you get decades worth of return in very short periods of time. The price for that is the volatility. It's, these stocks are, they can really go up quickly, and they can come back down quickly too. So that's the tricky part of it. But I'm pretty convinced. Obviously, I've made my own bets, and all my own money is in these sound money assets. That we are in the right place if we take a 2 to 5 year time perspective. I mean, I can't predict it happens Q1 next year. For all I know, all of next year could stink. I doubt that happens. Mm-hmm. What I'm seeing, the patterns I'm seeing about rivets popping out, and the charts as I see them and read them in gold and silver and how bombed out they are, I think we're slowly but surely turning the corner. It's probably a couple of years out, right?
Mm-hmm. I think, as we see those rivets, as you call them, let's say the most recent one, Japan raising their 10-year interest rate by 0.25%, we saw an immediate reaction in the gold market.
Oh,
right?
Yeah, right.
And it just seems like as these things pile up, it just, puts more and more kind of feathers into the cap for the metals, right?
Absolutely. And, it's frustrating. I know a lot of people in the category have been extremely frustrated. I've been frustrated. We're all been frustrated. But, bull markets do everything they can to throw you off. And sometimes they get you with boredom, and sometimes they get you with frustration. And, but, I haven't seen anything that alters the thesis. I mean, we are not going back to the old world. We're just not. I'm so highly confident of that that's why I'm so heavily positioned in this category. We're not going back to a low inflation world. That's gone until we resolve this debt issue.
So Larry, as you just mentioned there, solving this debt problem, I recently saw a tweet from you about a new Bretton Woods. So
Yeah.
how close are we to a moment like that, and what does that actually mean for the world?
Yeah. Well, none of us know what it means because there's so many moving pieces. But and the last one of these, I mean, broadly speaking, we're in a sovereign debt crisis, right? I mean, we had a dot-com bubble, we had a housing bubble, and we took it up to the sovereign debt level bubble, right? And so the last time we had one of these was in kind of the teens, 20s, and 30s from World War I, and then leading into the bubble of the U.S. stock market bubble and depression and so forth. And then we had a lot of debt built on for World War II and had financial repression to get out of it. Zoltan has called it for a new Bretton Woods 3. I mean, and we've seen other countries very aware and not, they're not stupid, right? They're very aware of the privilege we have for having the dollar as a reserve currency, and they're doing everything they can to put the rails in place so that they don't have to rely on that because they know it doesn't hold its value. Mm-hmm. And this is why we see the swap agreements. This is why we see, the Saudis selling gold in rubles, selling oil in rubles and selling oil in yuan. That's why we see them doing a lot more trade with each other, et cetera. I think ultimately the solution to this problem is to go back to a form of sound money. And ironically, we could do it tomorrow if we had the political leadership, but that's not present, so that's not likely to occur. I think what will drive us back to a form of sound money is when inflation becomes so outrageous and bad, Argentina-like, and everyone's just dying from it, and they're screaming that it becomes the number one political issue. Stop the goddamn inflation. Mm-hmm. And at that point in time, somebody's going to come up and say, you know what, we got to peg this money to something. We've got to balance the budget. We've got to peg the money to gold or Bitcoin or oil or commodity basket, whatever it might be. And if we don't, the inflation is going to continue. And so, but I think we're a long way away from everybody feeling that much pain and from us, selecting that solution. But you do have other countries. I mean, there are 6, plus billion people in the world. I guess closer to 7 billion people maybe now in the world. And other people are voting differently than we're voting. I mean, we're voting that, hey, the dollar is the right way to go and hold all your assets in dollars, et cetera, et cetera. Well, China, India, the Middle East, Russia to an extent are all betting more on gold, which as gold bugs, that's all good for us. And they're all looking for an alternative neutral reserve currency because they're recognizing that the dollar is at risk of being hyperinflated, because the U.S. government is out of control. Another way of looking at this, Tom, is people sometimes ask me, they say, what would make you worried about your thesis that you're wrong? Mm-hmm. Or, what should, if I'm going to invest with you, what could hurt us? Okay. And I always try and kind of look at what's the downside, what could hurt us. And people laugh when I give them this answer, but it is true. I mean, what could hurt us if the U.S. government got incredibly responsible and decided, yeah, right, you laugh. I see this laugh, right? I know it's absurd, right? And that's why we're all in this bet. But I think about the incentives, the way that they're aligned, right?
Well,
that's right. I mean, and that's why I think we all would agree that the odds of this are quite low. Mm-hmm. But if they decided we didn't have to be the world's policeman and we could close all these bases and we could cut all this expense and we weren't involved in these wars and we could means test Social Security and, right? And we would cut back. I mean, if we could balance our budget and, not be, and get on some kind of a debt repayment program, there's a chance that we could work our way out of this mess. Mm-hmm. But, as you and I both know, I mean, as investors, and therefore you have to kind of be a betting person with respect to playing the odds, it would seem that given the political constellation, the incentives, as you mentioned, the odds of that are low. They're very, very low. Maybe they become less low as everyone feels more pain, and somebody will come along and say, hey, part of the pain we're feeling is because we can't get our spending under control. Mm-hmm. That's possible. It's possible. So that's what I watch for. I watch for, if the government were to get incredibly responsible, our thesis wouldn't be as good a thesis, as good an investment thesis. Mm-hmm. But what I've seen is actually a trend in the other direction. And we're trying, it's at the Supreme Court now, but we're trying to forgive $400 billion of student debt. And that's not all of it. And what's to stop the next president from saying, okay, I'm just going to forgive all of it. Mm-hmm. You know what I mean? And we tested out UBI during COVID, and let's say we do have a severe downturn and a lot of people are hurting. I mean, we've already seen some politicians calling for, we're going to send people checks to deal with inflation. I mean, you and I both know that's insane. I mean, that's absolutely insane. It's making the problem worse. You're going to print money to send to people to deal with inflation. Well, to help them deal with inflation, sure, but by creating more inflation. So, there's just not a level of understanding at the government level, from what I can observe, that would imply that they're going to fix it on their own. I think sadly they're going to be forced to fix it when everything really gets shitty, which is to say very high inflation and a very bad economic picture. And I don't say that happily at all, because people will be suffering, everyone, including me and you. But I do say it because it appears to be analytically what's likely to occur. I also say it because it will lead to the solution. I mean, at this stage of my life, I'm more concerned with what's the world going to look like for my kids and my someday grandkids than I am about what it's going to look like for the next 20 years of my life. So, and I think we got to fix it. And to me, the sooner we fix it, the better. It's like we're living in a broken system. So why not recognize that it's broken, take that to its conclusion and fix it, right? Mm-hmm. That's kind of how I see it.
So Larry, considering you really straddle, let's say, both sides of the sound money camp.
Yeah, I do. Yeah.
And
I get shit from both sides, by the way.
Absolutely.
As
and I get shit every time that we talk about Bitcoin, but I think it's worth at least thinking about, at least having a bit of a discussion about. So
happy to do it.
What can Bitcoin do that gold can't?
Oh, sure. Yeah, I'm happy to talk about that. Look, first of all, everyone needs to understand what Bitcoin is, and everyone needs to understand that Bitcoin is not crypto. I think a lot of gold people correctly had a very negative view of Bitcoin because they viewed crypto as being complete bullshit and a promote, and they saw all the pump and dump and all that. And they were dead ass right, completely dead ass right. But they made a mistake. They threw out the baby with the bathwater. In my view, there is no need for any crypto other than Bitcoin. And because it's all bullshit, it's all wannabe Bitcoin, and it's fake, and they can print it, and it's FTX, it's all that shit. Mm-hmm. What Bitcoin is that people need to understand, Bitcoin is a computer algorithm and a cryptographic system that created something that never existed before. They created something called digital scarcity, so that we could actually have an address with an amount of coins in it that's digital, that's immutable, and that's scarce. And it's kind of like before the printing press, you didn't know what printing something was. So Bitcoin's digital scarcity. What Bitcoin can do that gold can't do is Bitcoin can store coins, which if people believe in them have value, then they do have value, because market value is perception, right? Mm-hmm. And those coins are, untouchable to anyone who doesn't have the private key, and they can be transferred anywhere in the world within 10 minutes. And at a cost of today about $1. So, I could send you, if I had the coins, I could send you $2 billion in coins value, today's market value, and it would settle in 10 minutes, and it'd be final. And that's pretty amazing, because to do the same thing with gold would cost a lot of money. I mean, billions of dollars of gold is a lot of 400-ounce bars. Each one's worth $750,000, and you'd have to put them in an airplane, and they weigh something, and you have to insure them, and the expense of moving it around would be much higher than the expense of moving Bitcoin around. Bitcoin can also allow people in third world countries to deal in a currency without having a third party that's either a bank or somebody that wants to rip them off. And I think one of the most humanitarian, there's a great book out, which I highly recommend anyone read if they're interested in it, called Check Your Financial Privilege, by a gentleman named Alex Gladstein, who I know is a wonderful gentleman. And his whole, the notion, the angle he takes is that Bitcoin has actually, and it's being adopted very much the way cell phones got adopted in some third world countries before they had landlines, because they could just put up a tower. Bitcoin is being adopted in some third world countries where people literally don't have bank accounts, but they have a smartphone and they can transact in Bitcoin, for pennies a transaction. Nigeria, 20% of Nigeria, it's a couple 100 million people. They're using Bitcoin as their form of money. And so the use case that a lot of people talk about is you're in South America and you send one of your relatives to the United States to work, and they make money in the United States. And of course, what most of those people do is they have remittances and they send money home to the relatives to help them. Well, by the time they paid Western Union their 7% take, and by the time they paid the bodega owner who they get the money from his 10 or 15% take, and then they're walking home with the cash in their pocket and they've got the risk of getting robbed, they're seeing, 15, 20, 30% of their money kind of get eaten up in the transaction. Whereas if they have a smartphone and they have a Lightning wallet, and I have, their relative in Texas who's working as a domestic has a smartphone and a Lightning wallet, they can send them $200 for less than a penny. Mm-hmm. And then, down there, they can either take that $200 of Bitcoin, use a local Bitcoin broker to turn it into the local currency, or if they're in a country where retailers and others are accepting Bitcoin, like El Salvador, which has adopted Bitcoin as legal tender, they can actually start spending those coins on things in their country. And so, that's a use case that, gold just can't do that. I mean, the domestic working in Texas isn't going to buy some gold and ship it to their relative safely, right? And now they could send money via, PayPal, but they pay for that. Or they could send it via Western Union, they pay for that. So the other thing that Bitcoin is that gold is not is it's verifiable. You can see all the coins on the chain, although there is paper Bitcoin. But in the case of gold, we really don't know how much gold there is. We really don't even know who has it. We really don't know if the central banks are lying. And we all know there's a lot of paper gold, and that's distorting the price. So in the sound money camp, one could argue that Bitcoin might be a sharper spear at kind of fighting the central banks and their ability to manipulate sound money. I mean, central banks do everything they can to discredit gold and discredit silver and discredit Bitcoin, because if everybody started adopting these things, nobody would want to hold the dollar, and that would not serve the political interest. I mean, it's the fact that the dollar is the reserve currency and the fact that they can print them that has allowed the U.S. to engage in all these wars, and that pays for all the government deficits, and that kind of creates the U.S. security state. And these two alternatives, three alternatives, gold, silver, and Bitcoin, take all that away from the fiat masters. And to me, that's a beautiful thing, because those people need to have the power taken away because they've abused it. Mm-hmm.
So conversely, Larry, what does gold do that Bitcoin can?
Well, the beautiful thing about gold is once mined, there's no additional cost, right? I mean, there's no energy cost. The energy is spent pulling the gold out of the ground, then it just sits there. Whereas the Bitcoin, I mean, if you're just storing your coins on your network, you're not paying anything for it. But the minute you want to do a transaction, you've got to pay for the transaction. And that payment is in the form of a fee, which now is low because there's a subsidy to the miners who are keeping the network secure. But the network needs to run. And obviously, if there were an EMP and all the power went out, they would reboot the network and all the servers would come back up eventually. But the point is that, gold just is. I mean, the way I say it is gold is analog sound money and Bitcoin is digital sound money. And gold has been around for 5,000 years. They both have zero counterparty risk because there is nobody who owes you your Bitcoin. The network collectively owes it to you. Same with gold. They just are. They're their final payment, their final settlement. And they're just different. I mean, gold is less volatile than Bitcoin. And so for that reason, a lot of older people and a lot of people in general, I mean, I advocate that everybody should have both, and that you should have a sound money bucket. In my case, that's probably about 100% of what I got. I don't recommend that unless you're really a believer. You should have a sound money bucket, and then within that bucket, you say, all right, what piece of this do I want to have as aggressive, that has more volatility, potentially more upside? Because I do think Bitcoin has more upside than gold. I mean, Bitcoin in 2020, Bitcoin went up 5x in 7, 8 months. 2020, early 2021. I mean, gold's never done that, right? Mm-hmm. So, and the reason for that is because it's under an adoption curve, right? I mean, we've got this old Malcolm Gladwell thing where we're kind of at the tipping point where like maybe 10% of the civilized world has Bitcoin or knows about Bitcoin. And so, now more and more people will be adopting it as we go up to the 90% adoption. And so because of that, and because of the fact that, the supply of these coins is fixed, 8 billion people, a couple 100 million people have it now. As more of those 8 billion want a piece of it, it's going to go up. I mean, another difference between the two, they're both, let's say they're both commodities. I mean, and they really kind of are. I mean, gold is a commodity. It's just a thing. I mean, one piece of gold is the same as another, assuming purity is held constant. One Bitcoin is the same as another Bitcoin. There's no difference. They're not marked. I mean, they do have UTX codes, but they're not marked. Most commodities, including gold, when the price goes up, the supply of them will go up. And that is true of gold. If gold goes to $10,000 an ounce, we're going to open up more gold mines. Now, we're not going to flood the market with gold because that takes 10 years. And, instead of producing 1.5% of what's out there, we'll produce 3%, whatever. Interestingly, Bitcoin's a commodity, right? There are only 21 million of them, but it's a commodity with a fixed supply. And the Bitcoin price could go to $1 million. They're never going to be more than 21. So the price doesn't respond the supply does not respond to the price in the case of Bitcoin. That makes it extremely unique. It's a digital commodity with a fixed supply. I mean, once you fully understand that and you realize that these things could go up 10x, 100x or more from where they are, as I say to my investors and people I talk to, even those who are very skeptical, I say, look, I'm not suggesting you put a big piece of your net worth in this thing, but I'm suggesting that if the amount of your net worth that you have in this thing is zero, you are not thinking it through all the way because of the optionality. I mean, even if you bought one coin for 17 grand, 5 or 10 years ago, that does 5 or 10 years ago, that does a 10x, that 17 becomes 170. Well, what if it does 100x, which I think it will? What if that 17 grand 10 years from now is worth 1.7 million? I mean, that would have moved the needle. Now, at that point, gasoline might be $100 a gallon too, but because we're talking about a lot of inflation coming down the road. But the point stands. I mean, there's a lot of optionality in Bitcoin, more optionality than in gold, but the price of that is the volatility. In gold, there's less volatility, right?
And as you mentioned to me earlier, you're more heavily focused on gold and
absolutely
miners.
My fund is 85% gold and gold miners, but that's not to say we don't think the Bitcoin's important, because in a real run, that Bitcoin could make a big difference.
So Larry, given all the drama that we've seen this year from the crypto space, many are calling for more regulation. So do you see this as a good thing to legitimize the space and bring big money in, or is it? I
do on balance, but let's make a distinction between good regulation and bad regulation. You've kind of got the Elizabeth Warrens who want to, tax all the miners and close it all down and have everybody report what they do, and who more or less want to regulate it and kill it. Do you know what I mean? And that's bad. I mean, I think that, it's an innovation. People are using it of their own free will. There should be full disclosure about the risks, et cetera. And are there bad actors in the crypto space? Absolutely. I mean, the bottom line is, to me, if you recall, before FTX, there was also Celsius and Luna. I mean, these are three big rug pulls where there were crypto coins that were shit coins that were frauds. There were Ponzi scheme frauds, and anybody who had any money in them lost all their money. These are unregistered securities, and the SEC should have been regulating these things. They should have been regulating. They should have been making a report. They all had CEOs. They all had people running them. Those people got rich. They probably hidden the money. Like FTX is, going to go to jail, but he stuffed a bunch of money away somewhere. So regulating the fraud out of it. Absolutely. And regulating even the good actors, and the good actors in the space, they're willing to be regulated. They are willing to live within the rules of reportability, auditability, proof of what they're doing, et cetera. There's nobody, the people who are in Bitcoin, in my observation, are honest people. They want a sounder monetary system. And as a result of that, they will live with logical regulation that creates a level playing field and fairness and kills the fraud. Now, they don't want illogical regulation that says, we're going to tax all the gains on this 90% and we're going to shut down the miners. And some of the stuff that Elizabeth Warren is asking for, we can't even do. It just proves how little her understanding is of the whole area. But by the way, once I think the regulation gets put in there, I know of big institutions here in Boston that I talk to who say, yeah, we get it. It is, and the SEC has said it's a commodity, by the way. We get it. We know it's a commodity. We probably should own some of it, but boy, it still seems a little bit too Wild West for us. We wish there were a little bit more regulation around and under, around all the players, and it were a little more stable. And once that kind of comes into place, we'll probably dip our toe into it. So in a sense, again, I say sensible regulation, I think, helps everybody. It helps the consumer, the investor, the companies in it, adoption of it, all of the above. Elizabeth Warren, the miners are going to, I mean, the WEF, as recently as 2 years ago, was predicting that Bitcoin mining was going to consume all the electrical energy in the world. I mean, there's an article that shows it. I could send it to you. Okay. In fact, the point of fact is that Cambridge House and others who've done the work, Bitcoin, the electricity in Bitcoin mining consumes 0.5, 0.5% of the energy produced in the world today. And we spend more on gold mining, we spend more on the banking branches, we spend more on all kinds of things. So to have a form of sound money that consumes 0.5% of the energy in the world today, I mean, I view it as a worthwhile trade-off. But that's the kind of FUD that's out there. I mean, you've still got people saying things that aren't true about it. So, but it's a good idea. Its time has come. This reminds me, I was a venture capitalist before I got into this whole sound money trade. And this reminds me very much of the internet. And there was a lot of FUD in the internet in the beginning too. And everyone thought, well, it takes forever. This dial-up, this modem makes noise. I get dropped. The screen's green. AOL was a nightmare. I mean, blah, 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 right? And yet, it got better. And that's what's happening here. Every year, the systems get better. The applications get better. The users get better. This Lightning Network is fabulous. I mean, everyone should download a MUN wallet, MUUN. Go to your app store and download an MUUN wallet. And you can send money to anyone else who has one. You can send Bitcoin for less than a penny a transaction. They can be anywhere in the world. You push send and they'll have it 1 second later. It's stunning. I mean, it's stunning. And by the way, there's no third party involved. And nobody saw that transaction. It's private too. So, it matters. It really does matter. But, some of the Bitcoiners say, well, gold's a brick and it's going to be gone. And, I mean, you're an idiot if you want to buy gold. And, they're wrong too, because, gold's been here for 5,000 years and 6 billion people understand that it has value and it is the core of the monetary system. It's not going away anytime soon. But they can both share the sound money stage. I mean, gold is analog sound money. Bitcoin is digital sound money. They each have different characteristics. I mean, the price for the upside in Bitcoin is the volatility, right? Obviously, you bought it at 68,000. It's now at 16,700. You feel like shit, But what you got to do, what I've been doing for years now, is you just dollar cost average it, because I'm pretty sure that that 68,000, that'll be taken out in a couple of years, And so if you're buying it at 17, you'll feel pretty good about that. So it's, look, the wheels grind slowly, but they do grind, and they grind fine. And the monetary system, this is a fourth turning. We've had this discussion many times. The monetary system is broken, and it's coming unglued. And this is going to be the topic of this fourth turning. And my great hope is that, to me, the other great fear, people say, what are you afraid of? I'm not really afraid of the government getting religion or any of the stuff that we talked about earlier. I'm only afraid that in the transition and the difficulties related to the transition, because in prior fourth turnings, very often we've gotten into shooting wars. And so what I'm most concerned about, what I hope we can all, spread the word about, get enough people informed and on the right side of the battle, such that these big nation states don't manage to start some kind of a stupid ass shooting war. They already have started a small proxy one, but more. I mean, Taiwan. Then somebody exchanges a nuke, then, we all know where this goes, right? And, if we can get through without that happening, the other stuff can be solved. All that'll happen there is wealth will be transferred. Some people will have more wealth and some people will have less wealth, and that'll be based on a new system. And those people who guessed about that new system correctly, which I think would include you and me and the people listening to this podcast, will be on the more wealth side of it. And those people who are holding bonds and fiat currencies will be on the less wealth side of it. And, that's unfortunate, but that's evolution, right? So.
Excellent, Larry. Well, I appreciate you kind of sharing with us some of your thoughts. I think it is worth considering that you can really send a lot of value over that network quite quickly. And if nothing else that you necessarily want to use it for, I think that's a great use case scenario. And I think the distinction between crypto and Bitcoin is an interesting one too.
That's a really important one, because that's what's tripped up a lot of gold bugs. I mean, the areas. I mean, those of us who are real hardcore Bitcoins, we hate the crypto guys. We hate them. Crypto, Web3, NFTs, all that stuff. It's total fraud bullshit. Complete and utter bullshit. And yet Bitcoin is a technical innovation that's been working nonstop without a failure for 14 plus years. And it's immutable digital sound money. And people say, well, you can't have digital sound money. Well, yes and no. I mean, guys sitting in caves, they didn't know what gold was, but they had marks on the wall. They kept score of who owed who what. And money is just keeping score, right? I mean, if you have money, it says, I owe you something or you owe me something. That's all it is. So it's a ledger. It can be physical. Gold is the best form of physical money. Always has been, probably always will be. But a ledger is another way of having money. If it's an immutable ledger, if you can't screw with it. And that never existed until Bitcoin was invented. And that's the important thing. I mean, that this ranks, in my opinion, this invention is of the scale of the printing press. It's a big one. It's a big fucking invention. I mean, before the printing press, you wanted a manuscript, you had to write it out by hand. Here you want a piece, you want something digital that can't be copied. The only solution in the world today that's backed up by thousands and thousands of computers and megatera, 300 exahash of computing power is Bitcoin. And that's going to be hard to turn around. And people say, well, it's this thing is this is MySpace to Facebook. No, it's not. I mean, in the early days, there might have been a chance of an alternative solution, but it's so deeply ingrained. It'd be like suggesting today that some other search engine is going to replace Google. I mean, the network effect of all the users, everyone goes to the same place, and therefore everyone advertises at the same place, and therefore, I mean, it becomes self-fulfilling. I mean, there's a network effect to the US dollar, right? I mean, it's the same drill. And so, there's a network effect to the Bitcoin currency that, it's so far ahead of all the others that no one's going to catch it, in my opinion. So everyone should have a little bit. That's all I'm trying to say. I'm not suggesting that, you should throw out your gold. Gold is beautiful, and gold will be around a long time, and it's going to, and they're both, by the way, in this next run up when the Fed pivots, they're both going to work great. I mean, and the gold stocks are going to work great. I mean, the stocks, God, they're so cheap. I mean, they're going to be multiples of your money.
Well, that's kind of the reason I wanted to ask you that question, is because, I know everybody has heard about Bitcoin, but I don't think that, the argument for sound money, people are going to be dramatically worse off for understanding more about sound money.
Well, that's right. That's right. And, let me go a step further, just because I think there's some of your audience probably been skeptical. Maybe I'm convincing them, maybe not. But I would suggest that there's one book in this area that I think will go into the history books as probably the most important book written on Bitcoin and sound money, ever, really. And it's called The Bitcoin Standard by Saifedean Ammous. And if you're skeptical of Bitcoin, this guy's an Austrian economist. He was a gold bug, like me. He's a gold bug. So but he became a Bitcoin guy, and he's an economics professor. He's a PhD in economics, very smart guy. And I highly recommend the book. Highly recommend the book. It's actually what gave me the confidence to pivot away from gold, because like a lot of your listeners, I was extremely skeptical in the beginning. It's like, Jesus Christ, money on a computer, the computer can blow up. I mean, it's not going to be secure. It can be copied. It can be hacked. I mean, there are a million things I didn't, but as you kind of peel away the layers, you come to see, all right, no, this actually, and frankly, years. I mean, in year 2 or 3, it was a lot less certain than it was in year 14. We've now got 14 years and 700,000 plus blocks of data that just keep growing. Every 10 minutes, another one gets formed, problem free. And, it's evidence to me that it's going to continue to work for quite some time.
Mhm. Larry, you write a quarterly letter. Are you
I sure
almost
do.
done
Yeah. So
the newest one?
people are, yeah, it's free. We'll never spam you. If you go to our website, EMA2, Edward Mark Alpha, the number 2.com, scroll down to the bottom, just put in your email. We don't sell them. We don't spam them. Every quarter, the letter goes out free. We also have, you go on there, there's some white papers and some charts and lots of other free stuff, just all oriented towards sound money.
Mhm.
So there's that. And then, as you know, Tom, because you see me there, I'm on Twitter, which, I'm kind of a loudmouth, and I use this. It's where I express my frustration with the central bankers of the world.
Mhm.
And so if you're looking for an account that dumps on central bankers, I'm your guy.
At
And
Lawrence
my Twitter
Lepard.
handle is just my name, yeah, at Lawrence Lepard. So the central bankers, boy, they've done us wrong. They've really done us wrong, and I'm pretty angry about it, and that's a whole different story. But the best thing we can do is to support sound money and work against them.
Mhm.
And they will fail. I mean, Marty Bent, who's a Bitcoiner and a friend of mine, as he says, relax, Larry, we're going to win.
Mhm.
And I think he's right. We are going to win. Sound money is going to win because
Mm-hmm.
unsound money doesn't work. And the world is demonstrating that to these people. So it's a good thing.
All right, Larry. Well, I appreciate your time.
Thanks,
here
Tom.
Towards the end of the year.
Yes,
And we'll
stay
look
warm
forward
up
to...
there. I know 30 below, man. I don't know. I couldn't live there.
Well, thankfully, I live in a spot where we get a good reprieve quite often from that crazy cold. But
yeah,
I do agree it's less than ideal.
Nice talking with you as always. Have a good new year. We'll talk in the new year, I'm sure.
Absolutely, Larry. Thanks for your time today.
Okay, thank you. Take care. Bye-bye.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.